post-market hours. Dinshaw Irani, CIO, Helios Mutual Fund, is with us on the show. Dinshaw, afternoon. IT stocks have done very well in the last 3 months as the markets have largely consolidated. The index itself is up close to about 7-8%. Do you think stocks are priced in too much and there could be some disappointments in the earnings season this time based on the positioning?
Yeah, thank you for having me on your show, and a very good afternoon to you and your viewers. Just a mild correction. I'm the CEO and not the CIO. CIO is Mr. Alok Bhal. So just to clarify that. Okay, sorry, I missed out on the question. It was about IT, was it?
Yes, IT and the way the street has positioned itself ahead of the numbers, given the run-up.
Right.
Does that make you skeptical then?
No, actually, IT, we've been fairly negative all along, and we continue to be so also. And in fact, our feel is that the hope has all been around whether there'll be a rate cut happening in the US or no, and that's because of that discretionary will come back into play. But given the recent announcement that higher for longer is what the way Fed is looking at, I don't think there's much hope there. Plus, what our feel is that the street is building in some hope for FY25, that the budgets will come back into place and things will look out. Actually, one quarter will not make a difference. December quarter onwards, you will start seeing the global players announcing their IT budgets. I don't think they'll move much of the ticket out there as such. So maybe CY24 will be not that great for IT. That's what our feel is. And probably from end of CY24 onwards, when things start working out, I think that's when you'll see. So probably CY25 and maybe FY26, to put it in that Indian context, will be the year to look forward for in IT. And before that, I don't think there's much hope here. Any of the valuations are pretty high still as compared to what the pre-COVID valuations were. And the growth rates are half of pre-COVID levels. So we continue to stay away from IT.
Okay. Dinshaw, hi, good afternoon. I know there's a lot of buzz at Helios, right? You guys must be very, very busy with the launch coming up. So looking forward to that. Let me actually ask you about your sector then. You've anyway been, big investors in, some of the marquee banking names, financial names. So what is it that you have your eye on looking into the future? I mean, any fresh purchases, insurance, asset managers, fintech players, beyond the usual blue chip bank names that we talk about? What else?
So basically, thank you for that question, Subi. But the fact is that we continue to be bullish on financials because that is where actually the growth comes in. I mean, in fact, we've been telling that whenever a GDP grows in a country, and the biggest sector to benefit is financials, because they don't only partake in the consumption growth, but also the capex needed for that consumption. So I think these two are the major pillars for finance, and both of them are kicking big in India. So obviously we are looking at not only say pure banks, private sector banks, we have some public sector banks also. We have mortgage companies in our portfolio too. So we are a mix of players. NBFCs, we have quite a few there also. So we always we're looking out for good names, new names to come in. But wherever the valuation is good, we'll probably be looking at those names as such. So continue to be on the lookout for this space.
Continue to be on the lookout for the space. What about consumer? Dinshaw, hi, good afternoon. As a overall kind of sector, again, another space where Q2 will, I don't know. We put out data from Bizom for staples yesterday. It showed that Q2 numbers will be overall down, but September there was a big build-up in anticipation of the festive season, etc. So maybe October to December things may look a little better. But your thoughts, not just staples, but durables, etc. as well.
So, Prashant, thank you for the question. But staples, actually, we've not been too keen on that because we also believe that valuations is one area and valuations plus growth. So growth in staples has been fairly steady at 11-12% while the valuations have been stretched at 60-odd times forward earnings. So obviously, that's not an appealing space for us. Secondly, I think even in that space, given that the rural economy is fairly stretched right now, the government may look at coming out with a lot of SOPs for that sector. So maybe some growth may come into staples, but won't be exciting enough. It will just be a blip going forward. But as you rightly put it, discretionary is the space that you want to be in. And frankly, I mean, discretionary is, as I said, that this is what moves the GDP of the country, right? Unfortunately, our discretionary space is limited to around 300 to 350 odd million people, but still that space is going to grow. I mean, that population itself of the consumers is going to grow going forward. And obviously the purse, which is right now being allotted to discretionary spend, will also grow because your per capita GDPs are going to grow. So that's an exciting space to be in. But once again, we need to be cautious on the valuations front. We did see quite a surge in that space. We did, at a portfolio level, we did reduce our weight a bit. And when we saw some correction building in, we bought back a few names and got into a few newer names also as such. So that's one area that we continue to be overweight.
Hi, Dinshaw. Good afternoon. Dinshaw, what about the auto and the auto ancillary space? You know, we were just discussing earlier in the show itself that some brokerages are giving some very sky-high target prices out there in autos as well as auto ancillary. How are you all placed on that theme?
So, Nigel, we actually are more keen on the ancillary space, and there also we being fairly selective. We don't want to go overboard on the ancillary part. But in the auto space, the main PV and two-wheeler and probably CV space, we not that gung-ho on that space, mainly in the PVs and two-wheelers, it's mainly because of EVs coming in a big way. And also one has seen a lot of build-up of inventories because of the festive season. In fact, our internal analysis shows us that in the PV space, the build-up has been almost 4 weeks, which is fairly high when it comes to inventories in the PV space. So one may see that evening out over the next quarter. But besides that, we're not too keen on the space. And once again, I mean, the commodity prices are slowly becoming more stronger, so that may create a problem on the margin side. And obviously, in the CV space, we are playing it through a financier rather than through pure CV players. So that's where we are today.
Okay. Got that. Yeah, I guess we've been speaking to the dealers as well. They say the inventory buildup is because they're anticipating an absolute bumper festive season. So let's see if that's how it indeed plays out. What else, Dinshaw? What else are your teams looking at? Any new ideas? Any new interesting stocks? We haven't spoken about the new age guys of late, whether it is Zomato or Paytm. Zomato's had a brilliant run. So any thoughts there?
So basically, I won't talk about the stock per se. But the fact is that platform providers is one area that we were very keen on. In fact, not only in the fintech space or in the food delivery space, we also had one in the providing, I think, mainly tourism space, if I would put it that way, very eloquently. So that is one area that we've been keen on. And once again, we were very clear that these platform providers, they should provide you convenience, and that convenience should be encashable and it should be mass convenience. But they shouldn't be replicable, right? So that's the 4 things that you should look out for when you're looking at platform players. And obviously, in India, the market is fairly huge. I think all these guys have just scratched the tip of the iceberg right now, and there's lots left to capitalize on. So we continue to be bullish once again, yeah. But again, as I said, that we keep looking at opportunities. When we find that the run-up has been sharp, we trim a bit, and then we get back in again whenever the run-up goes off. So that's what we keep doing out here.
Okay, got that. I was trying to guess in my head when you said travel services. I wonder if it's Ease My Trip. Anyway, I know you won't answer on the individual stocks, but just a follow-up question. Sorry?
It's not Ease My Trip. No.
Okay, it's not Ease My Trip. I'll rack my brains further as we go through. But just to follow up on a serious note, what kind of valuation multiples are you now willing to ascribe to these companies now that most of them are either already profitable or very close to being profitable? In terms of valuing these companies, what's the kind of headroom you think that remains out there? No one's denying or debating the opportunity. It was always about profits and value.
So it's actually about the potential. So here, actually, if you go to see on the DCF front, they're doing fairly well as such. So that's not a problem at all. But the fact is that on an overall portfolio basis, so you can always have these one-off bets where you know that the giving a justification valuation won't be there, but as long as the alpha is good out here. So on an overall portfolio basis, what you try to do is control the peg of your portfolio. And that's what we try to do out here, and try and keep our peg below 1, because that's where the real alpha generation comes in as such, if you are managing to do so. So I think that's how you should be looking at your overall portfolio. So obviously there'll be 1 or 2 stocks within where there will be a stretch on the valuations, but then you can live with that for a short period of time, or say a medium period of time, given the potential going forward.
No, absolutely. Got that. We'll leave it there. Thank you very much for coming on, as always, Dinshaw. It's a pleasure having you with us here on CNBC-TV18. We'll take a very quick